Good afternoon, ladies and gentlemen. So today we have one interesting question which reads to say we should prepare a tabular analysis. So we know for sure that for us to prepare a tabular analysis, we are using what is referred to as the basic accounting equation, where asset is equal to liabilities plus equity. So remember, the reason why liabilities comes first in the accounting equations before equity is that they are settled first when the company is liquidated. So for us now to prepare the tabular analysis, we need to understand the transactions. So the first transaction that we have, so we can just draw the tabular analysis here. So we can just put the tabular analysis down here. So we can put our equal sign here. So remember, these are the assets, these are liabilities, and this is owner's equity. In other words, people refer to it as capital. So we are told for sure that from transaction 1, the owner invested 25,000 cash in the business. Remember, when we are preparing the tabular analysis, we are preparing it in terms of the business, where we put into consideration the business entity concept, where the owner of the business and the business should be treated separately. So remember, when you invest money, meaning you're putting money in the business, which means you are increasing the cash account, and you are increasing the capital account. So we have our cash here, so which means you have increased your cash account by 25,000, and you have also put money in the business, and that is owner's capital. So that's owner's capital, which is 25,000. Then we have our second transaction, which reads to say the company purchased 7,000 of office equipment on credit. Remember, when the company purchases something on credit, we refer to it as a payable. Remember, payables, this is when a company owes someone. So immediately it purchases, meaning the equipment is coming into the business and the assets account is being increased. So we have the equipment account with us. So the equipment account will be debited with 7,000, and we are also increasing the payables account with 7,000 because we are owing someone and we need to pay at the end of maybe the accounting period or the agreed date. So the third transaction that we have reads to say the company paid 850 for this month's rent. So remember, when you pay someone, you are getting money from the business, which means you are reducing the capital. You are reducing the cash in the business because you have gotten money from the cash account to pay rent. So remember, rent is an expense, so we put a negative there. So rent is an expense, and remember it is already negative, so this would definitely become a negative. Then we have the fourth transaction, which reads to the owner withdrew 1,000 cash for personal use. So when you withdraw cash from the business, remember you are affecting the cash account and the drawings account. So immediately you get money from the business, meaning the cash account is basically losing money and it has lost 1,000, and the drawings account is gaining money. But remember, drawings are reducing the business and they are in negative state, so we also have a loss at the debit side, though it's a gain. Then we have the last transaction, which reads to say the company received 8,000 cash in exchange for services performed. So remember, when you receive cash for services performed, which means you have increased the revenue in the business and you have also increased the cash account. So you are debiting the cash account with 8,000. You are debiting the cash account with 8,000, and you are also debiting the service revenue account. So we can just say plus service revenue here with 8,000. So you can try by all means to balance the books. So let us balance the books together. So we will basically say 25,000 minus 850 minus 1,000 plus 8,000, and we get the value to be 31,150 plus 7,000 here, and we are getting the value to be 38,150. So this is how basically you balance the tabular analysis. So this is positive, it will come here, which is the 7,000. You have the 8,000 here and the 25,000 there. Remember, these are negatives, so they will come the way they are. So let us just add and subtract. So 7,000 plus 8,000 plus 25,000, we get 40,000 minus 850 minus 1,000, and we get the value to be 38,150. So this is how basically you can balance up a tabular analysis and you enter the transactions in it. So it is my first time creating such a video, but if people are interested in me continuing, you can let me know by commenting continue in the comment section, or we can just end on this particular question. Your host, Gordon Zulu.